last technique was internal rate of return, IRR. It says it is the IRR is the discount rate that makes the NPV, that is the net present value of an investment, equals to zero. Now here, what we do, sorry, we have to make sure that the investment which we have done in the business in upcoming years, let's say year 1, 2, 3, 4, it must be zero. Only then we will be able to know now the next step whether it is a good decision or not. It represents the rate of return, the investment which we have done in the business. Are we going to get double, triple, 4 times, 5 times back the profit expected from a project? Like when we buy shares in the business at the stock exchange, you people can do investment in the mutual funds. Like for the students and the people who don't do job, please do research about it. It gives you a chunk of money, which is a good thing. Mutual funds, and it's halal as well. It's not something which you need to get afraid of at all, like trading and everything. If the IRR is higher than the company's required rate of return, the investment is considered viable. What it means, the internal rate of return, if it is, let's say, 10, 20, 30, 40, and the company said that the rate of return must be 50. So what it is? This investment is going to be win-win. We will definitely opt for this. We have the formula. Why it says zero? Because we want the answer to be zero at all cost. Then equals to summation. Summation means total. Brown bracket, cash flow, the amount divided by 1. 1 is stable. Like, remember the formulas A plus B, A minus B, A2, B minus B2. This was also maths. You cannot change it. Like, these things are staple. So one is staple. IRR, which will be given to us. T stands for the time. In some formula, it is always N, mostly. So N is also time and T is also time. Once you calculate this round bracket first, then you are going to subtract it with the initial investment. Assume a company is evaluating a $100,000 investment with cash inflows of $30,000 annually for 5 years. Again, it is not mandatory that the cash inflow remains same for complete 5 years or 4 years. It depends on the question, whatever it is given in the brief, and in the brief it is different. Even for your assignment brief, I will be doing calculations in front of you people. So when you will be doing it, it won't be a problem, inshallah, for you as well. The IRR is the rate that makes the NPV zero. Obviously, that is what it means. IRR, we need to get it to zero. How? After doing the calculation, and it must be equals to zero. Now, using trial and error, that is financial software, the IRR for this example is calculated to be 14.87%. Basically, in the Microsoft Excel, you run this formula. If you want, I can show you that in your assignment class. Apart from that, I never opt for this method. But it's the most easiest one, after NPV is mandatory. If you want to run this formula of the software, if the majority says yes, I'll be doing it. And even individually, if Ritat, Sophia, Sarah wants to know that how we run this formula in the Excel, in the financial software, I can do that, okay? Because you cannot do it on your own. You have to use a software for this. And then you just get a percentage. That is 14.87%. When the NPV, that is IRR is going to be 14.87%, then we can consider it to be zero because that is the requirement of the business. This is why we're doing the calculation. Now, what is the advantages of IRR and disadvantages of it? The good point is it accounts for the time value of money, just like the NPV. It provides a percentage return that is making it easy to compare with other investments. Yes, because it is just a simple percentage. It makes the explanation easy when you're going to do the explanation of the paragraph according to the command web description. It gets easy. However, difficult to calculate manually. Yes, that is why we have the softwares. may provide misleading results for the non-conventional cash flows. What are the non-conventional cash flows? The old traditional one, for example, multiple negative cash flows. If we are regularly having the negative cash inflows, then it will definitely cause problem for the IRR. And I think in your brief, we do not have any negative inflow. So it's a good point. Even you cannot then opt for IRR as well. If there are so many negative inflows, then you can opt for IRR too. It assumes reinvestment of the IRR rate at the IRR rate, which we calculated, that was in your example, 14.87%, which may not always be realistic because it is a system-based calculation. We are not doing it by our own self. And if we do it, the numbers, they always vary. Real life application of the example of an XYZ manufacturing company, that it's not a real one, it's an hypothetical example. A manufacturing company is considering investing in new machinery that cost $500,000. The machine is expected to generate additional cash inflows of $150,000 annually for the next 5 years. The company required rate of return is 12%. What is, okay, I'll see whether you are able to understand this or not, what this rate is about.
I guess maybe they will get in return 12% of what they spent.
Discount rate. I told you that
Discount?
generally it is always 10%. But if it is given in the question, then you need to follow it as it is. And over here, it is 12%. Okay? So you have
Okay.
to see it, the question, what rate is given. Although in your assignment brief, it is 10%. Discount rate on which you're able to calculate that which year is going to give you more profit. You have to write the formula. I did not write the formula. Uh, please do write it. Average annual profit was board. It was given to us. That was $150,000. That was the additional cash inflows. We're going to add this in the formula. That is 150,000 the inflow divided by the initial investment, 500,000. And what do we get? The percentile in the ARR, that is 30%. Payback period, in how many years are we going to get back the investment back? 500,000 was the initial investment divided by cash inflows equals to 3.3 years. We have done everything according to the formulas and steps, okay? It is just an example how things are going to be in your brief. NPV, this is not the reality of NPV. NPVs are very long to calculate. This is just a shortage. You can say one aspect of it. NPV at 12%. Why? Because they have given us the rate of return here 12%. Then 150,000 was what? Your inflow divided by 1 plus 0.12. What was that R in the formula? Remember, R was the discount rate and into T. T was your time. For this, it was 5 years. That means you need to calculate for 1 year, 2 year, 3 year, 4 year, 5 year. And amalgamatingly, once you solve this bracket, you're going to get the answer after subtracting with $500,000. That was your initial investment. So my NPV is 27,739. IRR, I applied everything in the formula, Excel sheet formula, and I was able to get that at 15.47%. My IRR is going to be, that is internal rate of return proposed by the organizations. Now, based on these calculations, the company might decide to proceed with the investment as the NPV is positive. Over here, it is plus. The IRR is higher than the required rate of return, 12%. Maybe you're able to get to know it, that what actually IRR is and discount rate is from this example. In the question, the company is asking the discount rate to be 12%. But when you calculate it after using all these things which were given to us, the initial investment, the cash inflow, I was able to know that at 15.47%, the rate of return should be. So what it shows that it's a good thing. If I go back to the example, remember it was 14.87% the IRR, and in the question it was 10%. So again, this is a viable situation. Reading back the para, the IRR is higher than the required rate of return, that was 12%, and the ARR is favorable. Why ARR was favorable? Because we're getting 30% of the ARR. In total, it's a positive number. It is generating more profit to us. Each capital investment appraisal techniques provides a unique insight. Each capital investment appraisal technique provides unique insights into the potential profitability and viability of an investment decision because every method is unique from one another. NPV considers the best one and is compulsory. And apart from that, ARR and payback is very easy. Internal rate of return is also nice, but you need to go for the software calculations, which make things a bit tricky. While simpler methods like the payback and ARR offer the easy calculations, more sophisticated approaches like NPV and IRR account for the time value of money, making them more reliable in strategic decision making. This is the only reason why the organizations have made the NPV mandatory. Because if you compare NPV with IRR, NPV is still easy. But IRR, it gives you fishy answers. Actually, this is not a good approach to keep your investment on. By evaluating all the techniques, still in my, what do we call that? Lecture slides, you can even highlight I did not added similarities and differences in judgment. So what this shows that this is not complete thing. Evaluate completely means that you need to go for advantages, disadvantages, similarities and differences, and judgment. And conclusion is always at the end of the answer once you are done with everything. So business can make well-informed investment choices that align with their long-term goals. And these are used for the longer period of time, except the payback period. Everything over here is in detail, in depth. I tried my best to add. Okay, one more thing. This is exactly picture of the NPV formula, which I used to do in my childhood time as well. And it's available on the internet as well. It looks like this. Summation is always over, like on the summation we have n, that is the time, and time equals to 0, then CF is word cash flow, then again time plus 1 plus R, then T. It was difficult, it was tricky, now it's easy. I added the definition, I added the formula and the decision rule. Now how to accept which NPV number is going to be good for us. If the acceptance of the project is going to be a win-win situation, we have to accept it, then the NPV should always work greater than 0. You know these signs, right? Lesser than, greater than, alligator mouth.
Yes.
For mutually exclusive projects, pick the highest NPV. The value, the project AB, let's see, we have two projects. The number, which has the highest, as in the numerical form, you're going to go for that. Then we have the internal rate of return. That is, we assume that NPV must be 0. Formula, which I have to show you in the Microsoft Excel. Then payback period, that is all about time until cumulative undiscounted cash inflows equal the initial investment. The decision rules would be shorter payback period means giving the information about liquidity and risk. If you're getting the money very soon, it means there's going to be risk as well. Then many variants use discounted payback, which accounts for time value. We are using the 0.10%. Accounting rate of return, this is the formula, how first the definition, then the formula, how it looks like. Average annual profit divided by initial investment multiplied by 100%. And how do we calculate average annual profit? Total inflows less initial cost. Okay, divided by project life. 1 year, 2 year, whatever it is given, 5 years, let's say. Then we have strengths and weaknesses for the internal rate of return, payback period, accounting rate of return. Going towards similarities and key differences, I did not add this in your slides. Similarities and key differences. Time value of money. Now, NPV and IRR, they account for the time value of money if IRR is compared to discount rate only then. Discount rate, which is given in the question, that is sometimes 10, mostly 10%, and sometimes 12% or 5% as well. Then payback and ARR, these are the basic forms that do not consider the time value of money. So what are these? Similarities as well and differences side by side. Unit of measure. NPV always considers the currency that is dollar, pound, yuan, real, Pakistani rupees. IRR and ARR is always in the percentage of these. This is very important. Mostly students forget about it. They feel like that it's just a number. No, IRR and ARR, they always in percentage because we multiply the value with 100. And payback is always time. 1, 2, 3, 4, 5, so many years. Reinvestment assumption. Net present value assumes reinvestment at the discount rate. It totally depends on the discount rate, whatever it is going on. And IRR assumes reinvestment at IRR that is often unrealistic if IRR is high. Like my discount rate, you saw that in the question it was 12%, and the calculation was 14 or 16, something like that. So what it is unrealistic because the system shows it like this. That is why it is the most unreliable method to calculate the worth of the investment. Then we have the ranking conflicts. IRR can conflict with NPV when projects differ in the scale, or timing shows NPV for the value maximization because IRR and NPV are quite similar because of their formula and their critique. But the problem is IRR is always messed up and NPV gives you the accurate answers. However, the NPV always go for the value maximization. That is why business consider this. Complex cash inflows, IRR can be problematic for non-conventional flows, that is multiple sign changes. In year one, I was having positive inflow. In year two, I was having negative inflow. System gets crazy. NPV works reliably because we can do that manually as well. Judging the evidence, which method to rely on and when, this is the part of your command verb description. First thing is always financial and shareholder perspective. Primary rule, use NPV to choose between mutually exclusive projects when the goal is to maximize shareholder wealth. Obviously, when you need to return more money, you're going to opt for NPV calculation. Liquidity risk managerial perspective, if the firm is cash constrained, it has less cash in the business, or highly risk averse, that is for the short horizon period, a shorter payback or quick returns may be preferred despite lower NPV. That is, we're going to consider that to offer some other method. If there is capital rationing, that is using up the profitability index, these things are in depth, or solve for an integer programming problem to maximize total NPV subject to budget constraint. Like, what's the problem here? In the NPV, we are trying best to get the initial investment, but other than an initial investment, we have the other factors in the business. You have to think from the perspective of the management liquidity. There are the budgeting problems. We have to work on the profitability index, the total profit which we are going to get after we have given the salaries, expenses. So you need to see so many things, and then you have to select the best one. Behavioral perspective, managers often prefer the projects with the higher ARR or the faster payback period because they look good on accounting reports. You know, the annual statements, financial acquisition, income statement, balance sheet, cash inflow, we always try to add big numbers in it just to make it more representable and to make people crazy that this business is doing excellent. If you want to add theory in this work, you can even do that. Time value of money is the foundational finance concept that justifies discounting NPV. NPV rule is derived from the principle of maximizing wealth. It is theoretically considered decision ruler and a rule under the standard assumptions. This is actually accepted worldwide. IRR limitations are well documented in finance theory. Multiple IRRs and in reinvestment rate assumption that was 10%, 12%, 14% make IRR secondary to NPV. So NPV is always the best one. Behavioral agency theory says why managers sometimes prefer short payback and high ARR projects even when the NPV stays otherwise because of the performance reporting bonuses risk aversion. The factor which is known as ceteris paribus. Apart from things which you're watching out in the document, you need to consider the other factors as well. Recommendations. Use NPV as the principal decision rule, which we're going to be. Then I'll go for IRR and payback. Risk and liquidity caveat, if the firm has serious liquidity constraint, cannot fund the project via upfront cost or management places, then can definitely go for the other methods as well. Because we are going to compare two methods, A, B, not three. Then apply it to any two project assumption, you are going to do that. And this is what you need to do in your work as well. Choose a realistic discount rate in your brief. It is already given to us, 10%. Calculate NPV, we are going to do this. Then we have to select whether to go for IRR, payback. Payback tells the discounted payback, that is the time, and ARR is supplementary. Again, ARR is again supplementary. Consider the real options and strategic non-financial factors, that is ceteris paribus factors, which we did earlier as well. Over here, I think. Yeah, this para. That apart from profit investment, we have to consider other things as well. This is not the sole thing which we need to consider on. Make recommendation based on the NPV and justify using the supplementary metrics and qualitative factors. These two things need to be highlighted in your assignments as well. And this must be your final conclusion. That is, capital investment appraisal is about balancing the value creation with the rate of return, liquidity, and practical constraint. Use NPV as your default decision criterion because it measures the absolute value increase and aligns with the shareholder wealth maximization. We offer IRR, payback, and ARRs as complementary measures to communicate returns, SEC, liquidity. These are all the plus points of these methods. And for managerial performance context, rating methods disagree. That is, you think that they are causing issues. The answers, they are like abnormal. Then we explain why scale, timing, reinvestment assumptions, they can make a reasoned decisions backed by the sensitivity analysis and strategic judgment. So you can copy this para and like change few words and add this in your work as well. And this is just an example for you people, how you can do it. See, I added the discount rate at 10%, things adding up the formula. This is how it is in your brief as well. Everything is written like this. Project A, project B, adding things in the formula, getting up the final conclusion. You can make this table in your answer as well. That is assignment brief. That what is the calculation. Once we're done, it shows a very nice picture to the examiner and just paragraphs how we explain each and everything. And for your considering the tips for the assignment presentation, all formulas and work numerical NPV, explain the differences, it's important, then provide a short sensitivity analysis, that is calculation again, explain with a clear recommendation which to opt for, which not to. And again, this para can be copied in your assignment brief, just change the numbers.